Welcome to the Deep Dive. Today we are pulling back the curtain on a specific corner of the industrial world.
A corner that might seem a little obscure, but it's home to one of the most successful business models out there.
Absolutely, yet it's one of the least understood. We're talking about the Swedish serial acquirer.
And we're diving into a really high-stakes, fundamental, strategic pivot that's unfolding, well, right now in Stockholm.
Yeah, this isn't just about moving product or, optimizing a supply chain.
No, not at all. This is about strategic capital allocation and portfolio transformation. It's all centered on a company trying to emulate success.
And not just any success, specifically the success of the very companies it created.
Exactly.
Our subject today is Bergman Beving, or B&B. It's a large Swedish industrial holding company, and for years it's been flying, I'd say, somewhat under the radar.
Known mostly within the Nordic investment community.
Right. But B&B is fundamentally important because it is the progenitor. It's the original firm that launched this entire, now famously profitable, decentralized business model.
And that heritage is, it's everything in this story. When you look at the real high flyers in Stockholm companies like Adtech, Lagercrantz,
Of trading at these massive premium valuations.
Right. They are all essentially running variations of the B&B model. And Adtech and Lagercrantz, they were literally spun out of Bergman Beving back in 2001.
So let's get this straight. The original parent company is now, decades later, basically racing to catch up to the success and the high valuations of its own children.
That's the story. It's the classic and slightly ironic case of the parent needing to learn from the kids.
And that's our mission for you, the listener, today. We're diving into B&B's aggressive turnaround attempt, watching them try to adopt the winning playbook of their spinoffs.
All to close what is currently a massive structural valuation gap.
Right. So B&B is a serial acquirer of these niche B2B companies. And their whole thesis rests on two critical pillars:
An eternal ownership horizon, and a highly decentralized operating philosophy.
So the entire investment thesis, what it all boils down to, is whether the new management can successfully execute this portfolio high grading.
Can they move this company from being priced like a slow, cyclical industrial, which it is right now, to being priced like a high-quality, high ROIC compounder? That's the whole game.
Okay, let's unpack this unique B&B business model immediately, because understanding the DNA of these decentralized Swedish holding companies is, well, it's crucial.
It is. You have to grasp why they succeed and, why B&B lagged behind for so long.
So what's the philosophy here?
Well, the B&B model is defined by this motto they live by: small-scale enterprise on a large scale.
I love that phrase. It's incredibly descriptive. So for anyone listening who might be picturing a massive conglomerate with integrated factories, this is the exact opposite, isn't it?
Miles away.
Oh.
The structure is a really lean holding company at the center. It's like the strategic brain.
And it oversees, what, about 35 separate companies?
Approximately 35, yes. Highly autonomous companies, or subsidiaries. And crucially, each one operates with what the company calls great freedom.
And this is where the conventional understanding of corporate acquisitions just needs to be tossed out the window.
Right.
When a traditional company buys a competitor, the first thing they talk about is synergy, combining back offices, centralizing procurement, cutting sales teams to boost the bottom line.
But the source material is really explicit that B&B does not do this.
So that's the strategic secret here.
That's it. The value creation from the B&B parent company does not come from operational synergies. They don't force centralized manufacturing. They don't combine sales forces. They don't dictate product roadmaps.
They just leave the operational decisions to the local management teams.
Exactly. And that freedom is, paradoxically, their primary competitive advantage, which we'll see when we get to the M&A market.
Okay, so if they aren't providing operational support, what is the parent company actually doing? What's their core value add?
You can think of the parent as essentially an internal private equity fund.
But with that critical difference you mentioned.
The eternal ownership horizon, right. Their function is purely about financial discipline and growth. It really boils down to three core things.
Okay.
First, and this is critical, is capital allocation. They are the internal market maker. They direct funds only to the units that can generate the highest returns, and they deliberately starve the low-performing ones.
So they act as the internal sorting mechanism. The capital flows to the winners.
Precisely. Second is M&A expertise. This centralized competency means they have a sophisticated system for identifying, sourcing, closing, and structuring acquisitions for the whole group.
So they handle the complex deal-making part.
Right. It's a highly scalable skill. And the third piece, the thing that keeps the decentralized units from, flying off the rails.
The control mechanism.
That's strategic and financial control. And this is managed through their internal framework, which they call the B&B Toolbox.
A toolbox.
This toolbox sets the group-wide, non-negotiable financial targets and management principles. It ensures discipline even in a structure that preaches autonomy.
So it's where they impose the large-scale financial discipline onto the small-scale entrepreneurial freedom.
You've got it. That distinction financial control without operational intervention makes B&B a capital allocation engine first and foremost.
Okay, now let's look at what is actually in the portfolio, because this is where you start to see the legacy issues that management is fighting.
It is. They currently have 3 main divisions for the 2024-2025 fiscal year.
And as you pointed out, management has been systematically renaming these divisions. That's a key strategic signal, isn't it?
Oh, absolutely. They want to move the narrative away from being just a tools and consumables distributor, which carries low margin expectations.
And towards being a provider of niche technology and solutions, which commands those premium valuations.
Exactly. It's all about perception.
Okay, so let's break down the 3 divisions. Industrial equipment is the largest at about 36% of revenue.
Right. Then you have safety technology at 33% and core solutions making up the last 31%.
And we really need to hone in on core solutions for a moment.
We do, because it underlines B&B's vulnerability to the current macroeconomic climate.
Even though it's the smallest division.
Yeah. While it's the smallest at 31% of total revenue, it's heavily construction exposed. The source material highlights that a massive 83% of its revenue is tied directly to the cyclical construction sector.
Wow, 83%. And that division is anchored by their flagship subsidiary, ESSVE.
A very dominant Nordic brand in fastening technology. So think sexualized screws, bolts, mounting solutions for professional.
That brand recognition gives them market power, but that 83% exposure to construction, that's a huge anchor right now.
It is. I mean, if Nordic construction sneezes, B&B catches a cold, especially through ESSVE.
And that's compounded by the other divisions.
Yeah. The safety technology division has historically been home to the company's lowest margin business, Skida, which is, well, it's currently undergoing a complete upheaval via divestment. That's the central risk-reward bet we're going to get into.
Okay, so let's just clearly establish the geographical and cyclical concentration, because this perfectly sets the stage for the financial tension we're about to discuss.
The geographic focus is overwhelmingly Nordic, reflecting its history. Sweden is 36% of revenue, Norway 21%, and Finland 11%.
So almost exactly 2/3 of the business is concentrated right there in Northern Europe.
An area that is currently facing significant economic headwinds, especially in construction.
We're seeing management reports describing the Nordic markets as sluggish and weak.
Yeah.
That direct exposure has got to be painful.
It is. It filters right into the top line. And if you look at the end market breakdown, it's just as concentrated. 43% goes to industry and 39% goes to construction.
This concentration just ensures B&B is highly sensitive to the current downturn.
Which is exactly why management has to accelerate its portfolio pivot. They can't afford to just wait out the cycle with a low-margin portfolio.
They have to try and out-M&A their way out of the structural cyclical risk.
That's the plan.
And that takes us directly into the competitive landscape, which is, I think, truly unique here.
I agree. This is the most fascinating part of the B&B story, because standard competitor analysis it's basically irrelevant.
How so?
Well, when you look at the 35 individual subsidiaries, they're competing with thousands of small, niche, local players. Often the family businesses B&B wants to acquire.
But that's not the competition we really care about here.
No. The true competition is the business model itself, right?
Right.
B&B is competing with the companies it created and who are, frankly, executing the model better right now.
So it's competing against Lagerkrantz and AdTech, which it spun off back in 2001.
Precisely. Those two firms have perfected the decentralized playbook, and now they trade at massive multiples.
So B&B's competitive position isn't about selling better fasteners than its direct competition. It's about being this turnaround story, trying to adopt the playbook perfected by its own former businesses.
It's purely a capital allocation effectiveness competition. Can B&B's new leadership allocate capital and high-grade the portfolio as effectively as the established high flyers? That's the challenge.
Okay, but despite that handicap, they do have structural advantages that help them execute this M&A strategy. What are the key competitive moats?
The primary moat is tied directly to that highly decentralized philosophy and, critically, the eternal ownership horizon. This is B&B's unique selling proposition in the M&A market.
Explain that contrast, because it seems to be the key to their sourcing edge.
B&B is the ideal buyer for a very specific type of entrepreneur.
Right.
The owner who wants to monetize their life's work, gain some liquidity, but does not want to sell out to a financial buyer who will immediately strip the business of its identity or force them out after a few years.
So they are highly attractive to owners who want to stay on board and keep running the business with relative freedom.
Exactly. Now contrast that with the main competitor for these small, high-quality companies, traditional private equity.
Right. A PE firm has a fixed timeline.
A fixed holding period, yeah, typically 5 to 7 years. They are structurally required to sell, and they are usually highly interventionist, focused on cost-cutting to maximize their exit price.
And B&B guarantees permanent ownership.
It's the opposite approach. B&B says, we will buy 100% of your company, we'll give you capital for growth, but you keep running your business, and we will never force you to sell it again.
That non-interventionist long-term approach must give them a huge advantage.
It's a durable sourcing edge in M&A. They get access to deals and sellers that traditional PE firms can't even approach, and often at a more reasonable price.
That's a powerful moat. And the second advantage?
The second advantage is the M&A platform itself, the machine. The parent company has this centralized, sophisticated system for sourcing and structuring deals, and it's run by a CEO who closed 51 deals at Lagerkrantz.
A highly scalable platform that reduces the risk and friction of M&A.
Exactly.
Okay, so we've established the strategy and the moats. Now let's quantify the problem these moats are trying to fix, this massive valuation gap.
And the data is stark. I mean, it proves the market currently sees B&B as structurally inferior to its peer group AdTech, Lifco, Indutrade.
And this discount is based entirely on current operational performance.
Let's start with profitability. The last 12 months, EBITDA margin for B&B was just 9.8%.
Just under 10%. And how does that compare?
The peers trade on EBITDA margins that are dramatically higher. AdTech is typically running at 15-16%, Indutrade 17-18%.
The gold standard, Lifco.
Lifco is up in the 20-22% range. So B&B's margins are just structurally lower. They retain far less of every dollar or SEK they generate.
And that profitability gap translates directly into the lack of respect the market shows them in their valuation multiple.
It does. B&B's LTM enterprise value to EBITDA ratio is sitting around 15.3x.
15 times. And the peers?
They trade anywhere from 20x up to 30x. This is the crucial disconnect. The market is pricing B&B like a low-margin cyclical distributor. It is not pricing it as a high-quality compounder.
And just quickly for the listener, when we talk about EBITDA, what does that multiple really tell us?
That multiple is essentially a proxy for quality and predictability. A low multiple, like 15x, signals the earnings are either low margin or they're highly cyclical and therefore less reliable.
Whereas a high multiple of 25x or 30x
signals that the market believes that companies' earnings are high quality, durable, non-cyclical, and will compound reliably for a decade or more.
So the gap isn't just academic, it represents billions in market cap.
And critically, it translates into a dramatic difference in M&A currency. Their inability to access that high multiple actually costs them future acquisition power.
That's a fascinating point.
If B&B acquires a target with its stock, that stock is worth 15 times earnings. If AdTech buys the same company with its stock, it's worth 25 times earnings. AdTech can effectively print more valuable acquisition currency.
So B&B has to close this gap simply to compete effectively in the very market that's essential for its survival.
Which highlights the central investment debate. B&B is cheaper, but can they transform quickly enough to earn that higher multiple?
And we have to look at the financial tension driving this, which is the uncomfortable truth of the organic recession.
The company has maintained positive headline earnings growth for 22 consecutive quarters, which sounds incredible.
It does. But when you dig into the composition of that growth,
you see the intense pressure they're under. The underlying macro reality is brutal.
We mentioned the sluggish and weak Nordic markets.
And that directly translates into negative organic sales growth. In one recent quarter, the organic sales decline was negative 4%.
And that organic sales drop isn't just the macro environment. Management is sort of strategically contributing to it.
They are, and it's a necessary sacrifice. They are intentionally phasing out of unprofitable products and exiting low-return customers. It's part of the margin improvement strategy.
A necessary pruning.
But it directly accelerates the negative organic sales numbers today.
This brings us to what we're calling the M&A treadmill effect. You have the external environment pushing growth down and internal pruning pushing it down further.
So M&A is currently required just to offset the decline and keep the headline numbers positive.
And we saw this in the source data.
Vividly, total revenue growth of 6% was only achieved because M&A provided a massive plus 11% growth.
Which just managed to offset an organic decline of negative 5%.
The acquisition engine is running at nearly double-digit speed just to backfill the hole.
So if they're running this fast just to stay in the same place, how long can they sustain that? Doesn't the acquisition quality inevitably suffer under that kind of pressure?
That is the core execution risk. The pressure is immense. If the pace slows or if the quality dips, earnings fall.
And the bear case argues this treadmill is unsustainable.
Right, that eventually they'll either run out of attractive targets or be forced to overpay. And that brings us directly to the confusing financial headline, the GAAP net loss.
This is a critical point. B&B reported a net loss of negative 40 million SEK. If you only look at that number, you'd think the transformation is failing.
But the reality is almost the exact opposite. That negative income was purely an accounting loss, a massive non-cash event.
Caused by what?
A 270 million SEK goodwill impairment related entirely to the divestment of Skida.
So for the listener, what does that impairment actually represent? Is it cash out the door?
No, not at all. When B&B acquired Skida years ago, they paid a premium over its tangible assets. That premium is recorded on the balance sheet as goodwill.
Representing things like brand reputation, future earnings.
Right. And the impairment means management is officially admitting that the value they once assigned to Skida was never realized or was permanently lost.
So it's an admission of a past M&A failure, but not a reflection of current operational struggles.
Exactly. It's management clearing the slate, cleaning up the sins of the past to prepare for the future.
So to find the true operational earnings, we have to look at the adjusted numbers.
And there, the operational health is clear. The adjusted EPS came in at SEK 8.05, a solid 13% increase year over year.
And the quality of those adjusted earnings is confirmed by the cash flow.
Which is the lifeblood of this M&A model. The cash flow was robust, 509 million SEK in operating cash flow.
That huge divergence between negative net income and strong cash flow tells you everything.
It tells you to focus on the underlying economics, not the accounting statements. The cash flow is the foundation that supports the entire pivot.
Okay, let's move to that strategic pivot now. The heart of the risk and reward, the Skida divestment.
The Skida deal, agreed in March 2025, represents the CEO's boldest, most defining action.
The sale of Skida's core Nordic operations, this large, low-margin distribution business.
Sold to its competitor, Allsell.
Let's look at the operational impact of what they got rid of.
Okay, they divested approximately 550 million SEK in revenue and roughly 45 million SEK in annual EBITDA.
And critically, the EBITDA margin on that business was what?
About 8%?
About 8.2%, yeah, which was structurally dragging down the entire group average of 9.8%. And the transaction generated 300 million SEK in immediate cash.
So this is management making a very public admission that this asset just didn't fit.
It is. The rationale was explicit. B&B recognized it was not the best long-term owner for Skida. This move is the dramatic catalyst for portfolio high grading.
They realized that owning a large, low-margin distributor was structurally preventing them from ever getting to that 15% plus margin of their peers.
It had to go, regardless of the short-term accounting pain.
And here is the high-risk, high-reward gamble. The CEO has intentionally created a 45 million SEK bit hole in annual group earnings.
Right as the company is facing a brutal recession and negative organic growth.
Which sounds incredibly risky. Are they not terrified of the market reaction if they fail? That's the core tension. The CEO is betting that he can deploy that 300 million SEK in cash into smaller, higher-margin niche tech companies that will, in aggregate, generate more than 45 million in EBITDA.
So the success of the next few years rests entirely on the quality and speed of that redeployment.
If they sit on the cash, or if they buy low-quality businesses, that 45 million SEK earnings hole stays unplugged, and the whole thesis just collapses. The risk is immense, but the opportunity is enormous.
But they aren't waiting around. We're already seeing the redeployment in action.
The M&A pace is highly accelerated. 8 acquisitions last fiscal year, another 6 in the first half of this one. And you can see a clear shift in the type of companies they're acquiring.
It's consistent with the Lagercrantz playbook. Give us a couple of examples that really demonstrate this pivot.
The acquisition of Datalace in November 2025 is a perfect one. This isn't a bolt manufacturer.
Right.
It's a UK-based global leader in photonic printing. an advanced patented inkless printing solution. That is a clear, high-tech, niche asset with high IP barriers, miles away from safety equipment distribution.
And what about 8C Coils from July 2025?
Another key piece of the puzzle. 8C Coils is a UK manufacturer of bespoke heat exchangers. Again, it points toward customized industrial components that require deep application expertise.
Which is the trademark of the highest margin serial acquirers.
And these deals confirm two things. They are buying high-margin tech, and they are actively using M&A for geographic expansion. The UK is now 8% of group revenue, giving them needed diversification.
So the strategic goal isn't necessarily massive, short-term top-line growth. It's about a structural financial upgrade.
It's a pure margin expansion and return on invested capital story. The goal is mechanical. Transform B&B from that 9.8% margin distributor to a 15% plus margin serial acquirer.
By systematically replacing an 8% margin business with ones running at 15% or 20%.
The group's consolidated profile moves inevitably closer to its peers. The entire thesis is ROIC arbitrage.
This high-stakes transformation leads us to the leadership because the execution is entirely dependent on the person at the top.
Indeed. The whole thing is tied directly to CEO Magnus Söderlund, appointed in May 2021. This wasn't a rotational promotion, it was a targeted recruitment.
So they didn't just hire someone capable, they hired a certified Lagercrantz veteran.
They went straight to the source material to find the person who mastered the very playbook B&B invented and then, maybe, forgot how to use.
It's incredible.
Söderlund spent 15 years at Lagercrantz. He was responsible for M&A, closed 51 successful acquisitions. He was hired explicitly to replicate that proven model at B&B.
Which is why analysts sometimes call this the Lagercrantz 2.0 transformation.
His presence is the single strongest argument for the bull case.
That pedigree is essential, but equally important is the governance and alignment among the key players.
The alignment is exceptional, reinforcing that this is truly an owner-operator company. The shareholder structure ensures management can't make decisions for short-term gain that might jeopardize the long-term project.
Who are the key players here?
The controlling shareholder is Anders Bergman. He controls 19.6% of the votes.
And he's the original architect of the decentralized model itself.
Right, and he also happens to be chairman of AdTech. His presence ensures unwavering commitment to the vision. And the CEO, Söderlund, owns 1.19% of the company.
So when the CEO is personally invested and the board is controlled by the founding father of the model,
the risk of erratic short-term actions is dramatically mitigated.
Let's now look at the engine of this internal discipline. The B&B toolbox. You mentioned it's how they enforce centralized financial control. How does that actually work?
The toolbox provides the key internal performance metric for subsidiary CEOs. Profitability divided by working capital, or PwC.
With a target of what?
A target of greater than 45%.
That's a fascinating, highly specific metric. It's not just about profit, it's about profit relative to the capital tied up locally. Why PwC? Why is that better than a standard ROIC?
PwC is a proxy for ROIC, but it's tailored for immediacy and local control. The subsidiary CEO has direct control over their short-term working capital inventory, receivables, payables.
So by focusing on PwC, it forces managers to think locally about capital deployed right now.
Precisely. They can immediately see the drag caused by excessive inventory or slow collections. It's an actionable metric that directly impacts their day-to-day decisions.
If they hit that 45% target, they're generating 45 cents in profit for every dollar tied up in short-term assets.
And this is the mechanism that ensures decentralized freedom doesn't become financial anarchy. The toolbox dictates mandatory quarterly reporting on this.
And how is this metric used to drive behavior and, crucially, capital allocation?
It acts as an internal, self-regulating capital market. Subsidiary CEOs are sorted based on their PwC performance into green, yellow, and red zones.
Green is good, obviously.
If you are in the green zone, you've demonstrated capital efficiency. You get more capital for growth, including M&A bolt-ons.
And if you're in the yellow or red zones?
Your subsidiary is essentially starved of growth capital. You're forced to focus on operational efficiency, reducing inventory, improving working capital, before you get another penny for expansion.
So capital isn't sprayed equally across the organization. It's directed only to the most efficient units.
Which is the definition of good capital allocation. It's entrepreneurial freedom coupled with ruthlessly disciplined financial control.
That level of discipline is crucial. Let's shift now to how this cash generation powers the turnaround. We know B&B is a strong cash generator, 509 million SEK in operating cash flow. How do they prioritize that cash?
The framework is clear. Priority number one is reinvestment M&A to acquire high-return companies. The 300 million SEK from Skida is essential dry powder for this.
And priority number 2.
Shareholder returns. And this is where the confidence of the board shines through in a powerful way, especially with the dividend.
Okay, so despite reporting the GAAP net loss of 40 million SEK, the board proposed what?
They made a loud, intentional statement by proposing to raise the dividend for FY 2024-25 to SEK 4.00 per share, a 5.3% increase. Why intentionally raise the dividend in a year with a massive headline net loss? That seems counterintuitive. It is the board communicating, in the clearest possible terms, that they fully reject the narrative of the GAAP headline number.
They see the loss as a non-operational, non-cash anomaly, an accounting cleanup.
Exactly. Their decision is predicated entirely on the adjusted EPS of SE 8.05 and that massive real operating cash flow of 509 million SEK.
It's a deliberate signal of stability and commitment.
And looking at that SEK 8.05 adjusted EPS, the payout ratio is still very conservative,
Just under 50%.
at 49.7%. This is a highly sustainable dividend, backed by cash, not abstract accounting profit. The dividend raise is an exclamation point on the thesis. Focus on the cash flow.
Finally, let's look at the balance sheet flexibility needed to execute this high-stakes pivot.
Before they got the Skida cash, B&B's leverage was at 2.3x net loan liability EBITDA, which is manageable, but it's approaching the comfort limit for a cyclical company in a recession.
So the 300 million SEK in cash is critical not just for acquisitions.
Crucially, no, it serves a dual purpose. First, it's dry powder for M&A. Second, it's critical for deleveraging.
It gives them flexibility.
This cash allows them to immediately reduce their leverage, making significant room for more acquisitions without taking on excessive financial risk. The whole pivot is about recycling capital, not just piling on new debt.
Okay, we've laid out the strategy, the leadership, the financials. Let's summarize the investment debate, the bull case versus the bear case.
The debate hinges entirely on whether that steep discount B&B trades at is justified by its current quality or if it reflects an outdated pre-pivot reality.
Let's start with the bear case. Why is the 15x multiple justified?
The bear case says the market is being perfectly rational. B&B is just a lower quality company. First, the margin gap is huge, 9.8% versus 15.22% for peers. Second, they have negative organic growth, which requires that strenuous M&A treadmill.
And third, the cyclical exposure.
Heavy cyclical exposure to weak Nordic construction. The bear case argues this pivot is just too ambitious, too slow, or too vulnerable to macro to ever close that gap.
Okay, now the bull case argues the valuation is historical and fundamentally misleading.
The bull case is purely a bet on management execution. It argues that the discount exists only because B&B was saddled with low-margin assets like Skida, a problem the CEO is aggressively fixing.
So the bet is that the pivot Skida out, data lace in, will successfully increase margins and ROIC over the next 3 to 5 years.
And as those margins improve and the profile shifts from cyclical distributor to niche tech compounder.
The market will have to re-rate B&B closer to his peers.
Exactly. B&B is at 15.3x EBITDA. The bull case sees a clear path to 20x or 25x as the EBITDA margin moves toward 15%. If they achieve that, the upside is dramatic.
Every investment thesis comes with risk. Let's start with the controlled risk M&A execution.
This is the primary internal risk, and it breaks down into two immediate failure modes tied to the Skida deal. First is the failure to deploy.
The cash just sits there.
If that 300 million SEK sits idle, it's a massive drag on returns, and the 45 million SEK earnings hole stays unplugged, that would crush confidence.
And the second failure mode is even more dangerous. Poor acquisition quality.
Right. Under pressure to fill that earnings hole, management might rush and overpay for niche technology. They could buy businesses that don't deliver, leading to another goodwill impairment down the line.
A repeat of the Skida scenario would destroy management credibility.
Completely. That's the greatest controlled risk. Sacrificing quality for pace.
And what about the risks they can't control?
The uncontrollable risk is a prolonged macroeconomic downturn. If the recession in the Nordics goes deeper or lasts much longer than expected, it could overwhelm all the internal improvements.
The negative organic growth would accelerate and put extreme pressure on everything.
Cash flow, leverage, and ultimately the sustainability of that dividend.
Finally, there's the risk tied directly to the individual leading this charge.
The key person risk is material and can't be overstated. The entire Lagerkrantz 2.0 transformation is dependent on the specific expertise and vision of CEO Magnus Soderlund.
He's the architect and the driver.
His unexpected departure would fundamentally challenge the bull case and immediately raise questions about who could possibly step in to maintain that disciplined M&A engine.
It's the highest non-financial risk.
Absolutely.
This has been a fascinating deep dive into a company that is fighting hard to shed its past, clean up its balance sheet, and successfully embody the high-margin future pioneered by its own spin-offs.
The story of Bergman Beving is fundamentally a bet on management's ability to transform a lower-margin, cyclical distributor into a higher-margin, niche technology capital allocator. The entire shift is defined by the intentional creation of that earnings hole from the SCADA divestment.
And the key metrics for anyone watching are clear. Track the consolidated EBITDA margin. Is it moving towards 11%, 12%? And assess the speed and quality of the M&A.
Are those 300 million SEK in proceeds being deployed quickly into accretive, profitable deals like Data Lace and HE Coils?
And that leads us to our final thought. B&B provides a textbook example of why you, as an investor, must look beyond the headline numbers.
Here we have a company that reported a massive GAAP net loss, negative 40 million SEK, but simultaneously raised its dividend, showcasing the extreme confidence the board has in its economic reality.
They made that decision based entirely on their adjusted earnings and their massive operating cash flow, which is the only thing that actually funds the dividend.
So when you analyze complex companies like this, how critical is it to distinguish between non-cash accounting losses that address past failures and the actual recurring operating cash flow that defines the future?
B&B forces you to make that distinction, or risk completely misunderstanding the underlying value of the enterprise.
That's the key takeaway.
A great point to end on. Thank you for walking us through the high-stakes transformation of Bergman Beving.
My pleasure.